Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about one of the most versatile and effective momentum indicator available, the stochastic oscillator. This powerful tool has been a cornerstone of many successful trading strategies, helping them identify potential reversals and ride the momentum of the market. By the end of this video, you would understand not only how the stochastic oscillator works, but also how to integrate it into your comprehensive day trading strategy. Whether you are a seasoned trader or just a starting out trader, mastering this indicator can significantly enhance your trading skill. So stick with us until the end of this video to learn how to harness the full power of the stochastic oscillator and take your trading to the next level. We start by understanding what the stochastic oscillator is about, and this is a momentum indicator that compares a security closing price to its recent high-low range. It helps traders identify potential momentum shifts and detect overbought and oversold conditions in the market, which can signal a potential trend reversal. The stochastic oscillator consists of two main lines, the fast line and the slow line. The fast line is calculated using a formula that compares the current closing price to the recent high-low range. The slow line is a moving average of the fast line, which helps smoothen out the signal. Now, there are some key signals that we need to note from when using this indicator. The signals are the overbought and oversold conditions. Readings above 80, when you see a reading above 80, this signifies an overbought condition, while readings below 20 signifies an oversold condition. These levels can signal potential reversals. The second key signal you need to note is a crossover. When the fast line crosses above the slow line, it's a bullish signal, and when it crosses below, it is a bearish signal. Now, the third key signal you need to take note of is called divergence. And divergence occurs when price makes a new lower high or a higher low, but the stochastic oscillator doesn't confirm it and suggests a potential reversal. Example, price at this area made a lower low, but our stochastic oscillator do not confirm it. It made its own higher low at this area. This simply explains that there is a divergence, and this could signal a potential reversal either to the upside or to the downside in a bearish scenario. Now, let's see how we can apply this stochastic oscillator to a day trading strategy. We'll follow a step-by-step guide. And the first step is to determine your higher time frame trend. Now, first of all, you would have to check your daily time frame, and you can add your 100 period simple moving average to your daily time frame to help you understand the direction of the market. If we are to add a 100 period simple moving average, we would see that the simple moving average will be plotted on our chart, and it will show us the direction of the market. And as you can see in this area of the market, you can see that price is trading below the simple moving average, meaning that we are looking for selling opportunities. But in a situation that price is trending above the simple moving average, the 100 period simple moving average, this indicates that price is in a bullish trend. As you can see in this area, price is above the 100 period simple moving average, meaning we are looking for bullish opportunities or buying opportunities. The second step is to move down to your 15 minutes time frame. In this bullish scenario, we would move down to our 15 minutes time frame. When we move back to our 15 minutes time frame, we would understand better what price was trying to do at that area. Remember, our higher time frame has already told us that we are in a bullish scenario. Now, for us to enter a long trade, we would have to wait for the stochastic oscillator to drop below 20. That is the oversold territory. At this area, we can see price is below 20. Price at this area is at 1. The stochastic level is at 193, below the 20 region at this area, meaning that we should be looking for buying opportunity. You have to also look for where the fast line crosses above the slow line. The fast line is this yellow line. Once it crosses above the blue line, this signals for us to take our trade. And as you can see at this area, it crossed over here, signaling an opportunity for us to join this trade. In a selling scenario, all you need to do is to wait for the stochastic oscillator to rise above 80. If you want to sell, you wait for the stochastic oscillator to rise above 80. At this area, it is above 80, this is 90, and so on and so forth. You will now look for where the fast line crosses below the slow line at this area. This would be a typical area for you to enter your short trade, and it will be a selling opportunity after you have waited for your fast line to cross below your slow line, and you will aim for your 1:2 or 1:3. The fourth step is to confirm with price action. For long trades, you have to wait for the swing low pattern to develop. Swing low pattern in the sense of, after you have confirmed your entry at this crossover, you wait for a swing low. As you can see, there is a swing low at this area, which is the higher low. This is the higher low. Once the higher low has been formed, this would be a good place for you to enter your trade. While in a selling scenario, you would have to wait for a lower high to form. When the lower high forms, this would be a good place for us to enter our trade. The fifth step is to always set a stop loss when entering your trade. You set a stop loss at a distance that when price gets to that area, you know it invalidates the setup. So you set it in a selling trade, you set it above your swing high. In a bullish trade, you set it below your swing low, your most recent swing low. This is where you set your stop loss. This is where you set your stop loss. For your profit, you set it for a 1:2, minimum of 1:2 risk to reward. You set it at a 2 times your stop loss distance for a solid risk to reward. And you can also consider using key levels such as support and resistance areas as take profit region. And as you can see at this area, this is a strong resistance area. We can decide to use this place as a take profit region in the market. Same with this bearish trade, this selling trade, we can take our profits at the area where we expect price to react from, which is the support region. The seventh step is always to continuously monitor your trade progress and adjust your stop loss as needed to lock in gains. Be prepared to close your trade if the stochastic oscillator signals a reversal. How does it signal a reversal? When price gets to either the oversold or overbought territory. This is a signal that a reversal might occur. As you can see, we sold here, price got to the oversold region at this area. You can see it's trading below 20, meaning an oversold region. You can exit your trade when we see that signal. And the buy trade, when price traded and came to this area is a typical example of an overbought region. You can exit your trade at that area. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.